Thanks. You can say what. All right, let's go. Let's go. Let's go. Let's go. All right, so we're doing the journal entries. Just going to run through these. So the first one was 2008 on December 31st. And this was the one to record the bad debt expense, which was the 1% of the credit sales. So, as normal journal entries, bad debt and expense, say debit it 1% of the 450,000, so that's 4,500, and you credit your allowance for bad debt, which was what we did in the ledger, 4,500. Next, on December 31st, we did the closing entry. So we're going to close this off now to the income summary. So remember that your income summary is where your expenses go. So if you're going to close your bad debt account, then you have to ensure that whatever you debited it with, then you credit it with the same amount to basically level it off or close it off. Let the balance be zero, right? So now this is the bad debt expense that is going to go to your income statement, this 4,500. So you debit income summary with 4,500 and you credit bad debt to close it off with 4,500. Now on February 4, it says sold inventory to Marion Holt, 1,500 on account, right? It says ignore cost of goods sold because normally when you're dealing with an inventory adjustment, the account that you normally pair it with is COGS, but now it's telling you to basically ignore it. So you sold it on account. So here arises your account receivable account. Remember that account receivable is a current asset and as such is debited as well. Remember your sales revenue is always credited for the most part. So you're increasing your accounts receivable, that is, you're increasing your debtors. So you're debiting M Holt accounts receivable 1,500 and you're receiving revenue even though it's not paid for. Remember that revenue is recorded when earned. And when it is earned, that means when the goods or services have been delivered, whether or not they have been paid for. So you're also increasing your sales revenue, and to increase your sales revenue, you credit it 1,500. Moving on to July the 1st. This is where we wrote off M Holt's account, and this is similar to what we did in the ledger. So to write it off, we're basically taking it out of accounts receivable because we're saying that, hey, we're not going to get this again. So what are we going to do? We're taking it out of accounts receivable and we're also lowering our allowance because it is the allowance that is going to have to fund this bad debt. So if you're taking it out of accounts receivable, that means you're lowering your accounts receivable, thus crediting it 1,500. You're also, as I explained above, decreasing your allowance. So decreasing your allowance, which is a credit account, you do the opposite, which is the debited 1,500. We're moving on to November 19th. This is where now we basically got back the amount that we thought was going to be bad debt. So we have to do two entries here, right? Remember that we wrote it off. So basically we have to put it in back, if that's afraid. Yeah, basically we have to put it back because we took it out, we wrote it off. So now we have to put it back first and then do something else. So the first thing we do is to reinstate accounts receivable back to the original. So to do that now, we have to debit it again because we're trying to make it as it was before July 1st happened. So now we're debiting accounts receivable with 1,500, and we are doing this back again. So we're basically doing the reverse of this. And now we're crediting allowance for bad debts with 1,500 because we want to be restored to before July 1st. We want to take out July 1st out of it because now she's giving us back our money basically. Well, she's giving us our money, not back on. And then the second journal entry that you're supposed to do is remember that you received the money now. So you have to record that money as cash for 1,500. And then you lower the account receivable now, which was the right thing to do initially if the debt had not gone bad. So because she paid you, you increase your cash with your 1,500 and you take her out of accounts receivable because she's not a debtor anymore. She paid you, right? So you lower accounts receivable 1,500. We're at December 31st. This was where we wrote off these three persons' debt. And similar to what we did in the ledger, we are writing them off. Remember, when you're writing off something, you're taking them off your books as a debtor. They are no longer debtors. So that is the reason why we credit accounts receivable. So we credit all of them. We take them out of our books. They are no longer our debtors. These are no bad debts, right? And then we are going to the allowance that we had is going to fund these bad debts, right? So we're lowering our allowance as well, and that is why we debit it, right? So it's important to remember what kind of balances the accounts have, because if you know that account receivable always carries a debit balance, then if you're going to lower it, you'll know that you're supposed, yes, it is a credit account. So if you're going to lower it, you'll know that to you're supposed to credit it for account receivable. So now we're moving on to December 31st. The other one, this is where we found the bad debt expense for 2009. Yeah. So that bad debt expense was 1% of the credit sales of 480,000. So 1% of 480,000 would be 4,800. And so we record our expense by debiting it, 4,800, and we credit our allowance for bad debt, 4,800. And lastly, we basically transfer this to the income summary. We close it out. Just like what we did up at the first one. You can talk to me after I'm finished, because if I go back to the ledger now, then we're going to be running out of time. So just private chat, message me or something. Alright. And then part C, which is a simple balance sheet extract, asking you to show what would be the accounts receivable at the end of the year. Remember, in your balance sheet, when you're writing down your current assets, you normally have accounts receivable minus allowance for bad debts, or you have debtors minus your allowance for bad debt, right? So same thing here. They told you the amount for accounts receivable being 164,500, and no, you might ask, where does this allowance for bad debt 5,300 come from? This is coming from here, from our ledger, the last figure that we had when we finished all the running balances. So accounts receivables minus the allowance for bad debt, this would be the net accounts receivable, which is the figure that you use when you're doing your balance sheet. So that that is basically a receivables question. Yeah, that is receivables. Should I go over bank recon? All right. So bank recon, same practice, same worksheet 3, practice question 2. Guys, please look at the question so that you can see what I'm doing. Try to see if I can bring up both. All right. So bank reconciliation. So what are we trying to do first? What are we trying to achieve? So in bank recon, we're basically trying to get our bank statement balance to be the same as our cash book balance, right? So there are certain times, oftentimes there are some activities that result in the bank book balance having a different number from the cash book balance. So that is why they do bank recon, to try to get everything back in order. I'm going to try, I need to show you something, so I'm going to try to share both. Um, Give me a minute, please. You're still seeing, right? All right, so practice question 2, bank recon. So what are the requirements for this question? So we're given additional data, and we're asked to prepare Silver Maple Arts Gallery bank reconciliation at April 30th, 2014. Prepare journal entries and prepare journal entries. So before we go into the bank recon, we're going to go worksheet 3, sorry, practice question 2. So before we go to the workings, we're going to go through the additional data. Right? The first one, I, says the electronic funds transfer deposit was a rent receipt, and the electronic funds transfer debit was an insurance payment. So my best explanation for EFTs would be like for those of us who do online banking. So basically, if I go on my online banking account and transfer something to you, saying we're businesses, and I transfer something to you, then it's going to show up on your bank statement, but at your physical establishment in your cash book, you may not have it there until like a few days after, or when you can confirm for sure that the cash has reached your account. The same thing for a payment. Same thing for a receipt, same thing for a payment. The person on the other end will have it in their bank book basically, but on their physical cash book, which would be in their establishment or on a computer in their establishment, it might not be there. So that is why we always see the need to reconcile electronic funds transfer, right? So it says the EFT deposit was a receipt of rent. So let's search for the EFT deposit, and it would be right here. This $300. It was a receipt of rent. So basically, somebody is paying us. So you can probably jot this down if you have the worksheet near you or something. Somebody is paying us rent, and it was transferred to us. So it's on our bank book balance. However, it did not show up in our on our cash receipt. See, if you look here on our cash receipt, we're not seeing anything with $300. So obviously, we don't have it on our cash book. So if we want our bank book and our cash book to be looking the same, then by right, you're going to have to add this amount to your cash book, right? So you can just jot that down beside it. The next thing that it says is that the electronic funds transfer debit was an insurance payment. So now we are paying someone by transferring an amount, and the debit would be here, this $200 EFT. So now we are paying somebody by transferring an amount to them, right? So that means we're losing. And this $200 now, we look on our payment side of our cash book and see if we see it. I don't see any $200. So that is basically telling me that it was not recorded on our cash book either. So therefore, this one, and you can jot it down as I said beside it, this one we'd have to take it out of the cash book balance. Everyone understands that? All right, let me go over it one more time. So, sure. So before we go into the workings of bank recon, we're going over additional data so that when we're ready to work the bank recon, we don't have to be considering what we should do with the additional data, right? So the first one says the electronic fund transfer deposit was a receipt of rent. And then it says the EFT debit was an insurance payment. So there are two EFTs. One was a receipt. One was a receipt that we got. So one was a transfer that was sent into our accounts, and one was a transfer that was sent from our accounts. One was a payment, right? So EFT has to do with, as I said, my best explanation is by using your online banking. So we look in the bank statement for our EFT. So the first one, which said it was a receipt, we're going to look on in the deposit section of the bank statement, because if we're receiving something rather, that means it was deposited in our account. So therefore, this $300 with EFT beside it was the electronic funds transfer that we got. That was the rent payment, that was the rent receipt that we got. Somebody basically transferred their rent money to us, and it's there in our bank statement. So what we have to do now is to check if the same amount was on the receipt side in our cash book. So we're going up to our cash receipt, and we're looking on the debit side to see if we received any $300. And as we can see, there is none there. So this needs to be reconciled. So if it is that our bank statement is showing us that we have received $300 for rent and it is not yet on our cash book, what do we do? Remember, we're trying to get the balances to be the same. So therefore, we have to add that $300 back to our cash balance. So as I was saying, so that when we're going through the entire statement, you can just put a note right here that this is going to be plus to the cash balance and addition to the cash balance. This is one of the things that you're going to add to the cash balance. On the other hand, now, the EFT debit was an insurance payment. So now we're going to look on our debits in our bank statement and we see a $200 electronic funds transfer, right? This is an insurance payment. So basically, this is us paying our insurance company. So now we're going to look on the payment side of our cash book and look if we see that same $200 because we're supposed to have everything on our cash book like in our bank statement. There's no $200 there. So therefore, we will have to reconcile for that as well. So if we're paying somebody $200 and we transfer this amount to them, then what would we have done to our cash balance? Of course, we would have taken it away because it's a payment. So now you can jot down right beside that one that this one is going to be subtracted from the cash balance. So one of the EFTs you're going to add to the cash balance and the other you're going to subtract. It's clear now? All right, great. So we're moving on to part 2. Or, yeah, 2. The unauthorized signature check was received from a customer. So here the key is telling you that US means unauthorized signature. So we're going to search for the unauthorized signature check. And another name for unauthorized check is dishonored check. Because basically if your check, if the signature on the check that you bring to the bank does not add up, or if the signature is wrong, or signature doesn't matches the person's name on the account, then it's going to be a bounce check or a dishonored check, right? So the thing says the unauthorized check was received from a customer. So yeah, so this is the check was for $900. So this is $900 that we received, but it's bound basically. We not really get the money because it wasn't authorized. So let me go up here. Yeah. So as I was saying, this unauthorized check that we're talking about now, as I was saying, unauthorized check, dishonored check, bounce check, same thing, right? So receive this check, $900, but it turns out that we did not get to cash this check because we can't send through a check with a signature that is not matching up to the person's name on the account. So therefore, we would have written this down in our cash book as we receive in cash, right? But no, the check bounced. So basically, have to take this out of our cash balance. Out of our bank balance. rather, let me go over this again. Unauthorized check is a check that this one was received by received from a customer. So basically, the customer gave us a check. We couldn't cash it because the signature on it was not matching up. That's that. Now, we would have known already from our accounting for cash that we would be receiving this check, right? So this would have been included in your cash book amount. So basically, if this check now turns out to be dishonored, then the same amount of that is on the check, which here is $900, you're going to have to let that same amount from your cash book balance. You have to lower cash basically by that amount. Why? Because we did not get the money from the check. So right here beside 2, you can just put a minus from cash balance. So we're going on to 3. It's here. The key says US means unauthorized signature. And then if you look in the bank statement, you see $900 US. So it's basically telling us that the unauthorized signature check was for $900. All right, so 3. The 1,300 bank collection was for a note receivable. So BC means bank collection. So we're going to have to search for it. And it's up here, the 1,300 BC under the deposit on the bank statement. So this one is similar to the EFT received. It's basically a note receivable. Note receivable is something, money that you receive, some long-term money that you receive, I think. I don't clearly remember, but I think that's it. So you basically receive 1,300 in your bank statement, and this did not show up on our cash book. And we can check as well on the receipt side, there's no 1,300. So obviously, this was not recorded on our cash book, in our cash book rather. So this one now is, and I think it's a general rule that note receivables are always added to cash book balance. I'm not entirely sure if I remember, but I do think so. So this note receivable, you can put a little thing beside it, plus or add to your cash book balance. It's similar to the EFT. It's basically an amount of money that you received in your bank statement, but something that is not showing up on your cash balance. So in order to reconcile the two ending figures to be the same, you have to add that amount to your receipts in your cash book as well. And the last additional data, the correct amount for check number 315 is 1,390. Mistake, Silver Maple Art Gallery's accountant mistakenly recorded the check for 1,930. All right. So we're going to look for the check. It says check number 15. So as you can see here, check number 15 is 1,390. So they said it was recorded for 1,930. If we look here, we see the same 3 check. Are you hearing me? Okay, great. All right. So if we look on the cash payment side, we see the same check 315 for 1,930. So no, this one wouldn't be a dishonored check. This one is an error. The correct amount is supposed to be 1,390, and the correct amount is on the bank statement, right? A bank error. But on your cash book, they recorded it as 1,930. Here it is, 1,930, right? So therefore, it's a check that you are paying. So if you write in your cash book that we're supposed to pay 1,009, if you put a payment in your cash book rather for 1,930, that means that you paid the person 1,930. However, it's actually a book error, not a bank error. This one was made in the cash book and not on the bank statement. So it's a book error. So you were supposed to pay 1,930. You wrote down in the cash book that you paid 1,930. But it says that the correct amount is 1,390. So basically, you paid the person too much cash. You paid the person too much out of your cash. So what are you going to do to correct this? Yes, you're going to have to add back the difference between 1,930, the difference 1,930 minus 1,390, which would give you 540. So you have to add that 540 difference back to your cash book because you made an error in recording a higher payment than you should have. So now we have gone through the additional data. We're going to go through the actual bank recon statement. So you put your headings, and the first thing is balance as per bank statement. You look for your balance as per bank statement. This is your bank statement here. Bank statement for April 2014. Your ending balance is 18,102. So that is the first figure you put down, your balance as per bank statement. Before I move on, did you understand the additional data? Right. So balance as per bank statement, 18,102. All right, let me run through the last two. Quick. The 1,300 bank collection was for a note receivable. Now, when you say receivable, that basically means that you're getting money, right? So the key tells us that BC is bank collection. So therefore, look in your bank statements, you see 1,300 BC. So therefore, the note receivable was, we received $1,300. That's what we received in our bank. The bank collected that for us. This can be something like, some persons like have account with the bank and they authorize the bank to pay some of their loans or some of their debt on their behalf. So this is a bank collection. As I said, some person authorized the bank to pay something for them. So this showed up in our bank book because, say for example, Olivia, you are supposed to pay me for some things that you bought, and you authorize your bank to pay to my account every end of month, right? Or say every 6 months because it's a note receivable. So let's say every 6 months. And your bank paid the $1,300 to me. So that shows up in my deposit. However, this doesn't show up in my cash as well, because this doesn't show up in my cash book as yet, because this was probably this came in the evening after the cash book was finished, after we finished preparing and closing off the cash book. Probably it came on a weekend, something of the sort, right? So we don't have this figure recorded in, hold up, we don't have this figure recorded in our cash book, right? So basically, what do we have to do to ensure that the cash book is reflective, the cash book balance is reflective of the bank statement balance? We have to add this receivable because it's money that we are getting. Right. So we have to add this receivable back to our cash book balance because it wasn't there, and it's obvious that we got it because it's in our deposits on our bank statement. So that is why we add it back to the cash book balance. The last one now was a book error. We basically we paid a check. We gave somebody a check, and the check was rightly supposed to be 1,390. But in the cash book, we recorded it as 1,930, and it's a payment. So that means we took out $540 more than what we should have taken out. So in order to get it back to the correct thing, correct figure, correct ending balance, we have to add this 540 to correct the error because we took out 540 more than we should have from the cash payment. So that's that. So in bank recon, the first thing is your balance as per bank statement, and that's a given, $18,102. The first thing you add, if you're following the formula that you have, is your outstanding deposit, right? So outstanding deposit, why do you add these to your bank statement balance? I think outstanding deposit represents those monies that you would have deposited, or probably you use some bank has some outside depository. So probably you went to the bank, you deposited $200 using their depository box on a Friday. And if you go there on a Friday evening and use the depository box, that's not going to come up until Monday. So when you closed off your bank statement that Friday evening, those deposits were not included. So now we have to check our cash. Hold up 1 minute. Yeah. So we basically have to check our cash receipt to see if all the receipts that we have were included on the deposit section of the bank statement, right? So we go up to our cash receipt, which is here. And I'm going to have to be going up and down. So you can check on your worksheet. April 2, 4,174. We're seeing that on the bank statement. I'm seeing that. I'm seeing 501 as well. I'm seeing 559 as well. I'm seeing 2187 as well. I'm seeing 1854 as well. 1060. I'm not seeing that in the deposit section of my bank statement. And 337, neither am I seeing the 337. So there are two receipts that were accounted for in cash that is not a part of our bank statement. So basically, this is telling us that they recorded these and these did not show up on the bank statement as deposits, so they must have been outstanding. So we add these two amounts, the 1,060 and the 337, and we get 1,397 for our outstanding deposit figure. We add that to the balance as per bank statement, and we get 19,499. Next thing we go on with less unpresented check. So these are the checks that we, Silver Maple Art, the business, would have paid out that was not presented for payment. So they basically were not recorded in the bank, in the bank statement. So let me go over that. Let me use Olivia again. So Olivia comes to my business, which is Silver Maple Art, and all right, let me just say 10 of you guys come to my business, which is Silver Maple Art, and I give you guys 10 checks labeled from check number 1 to check number 10 that you're supposed to present to the bank so that you can collect the money on this check. Say that you're 10 workers or you're 10 creditors, people that are owed, right? You're supposed to present it to the bank to collect the money on these checks. I, the business, would have written it down in my cash book that I paid you all. So hence here, you can see all of the checks that I paid. I recorded that I paid out. However, when I got to my bank statement, I realized that only 6 of you guys came and collected your money. So basically, I paid you. There are 4 checks out there somewhere in the world, 4 persons out there that have not yet gone to the bank to cash out their check. So basically, that's an unpresented check for my bank statement because it's not yet presented to my bank account. You have not yet collected your money. So therefore, I still have money in my bank account that you guys should come and collect. So that is why I am going to know how to less minus subtract all of these unpresented checks from my bank statement balance. So if we go up here on the payment and we look, we have to match what we have on the cash payment side to what we have on the bank statement. So if we look, we have from 313 to 318. We have 313, 314, 15, 16, 17, 18. The persons who have not collected theirs or who have not brought their check to the bank to be cashed out are 319, 3119, 3120, 3121, 3122. So those 4 checks are unpresented. So the monies that should have been paid out from those 4 checks, those 4 persons have not yet come to claim it. So I don't want my bank statement to be looking like it to be having an amount that is higher than it should be, right? So I'm going to less these 4 checks because by right, these persons, if they haven't as yet, they should be soon coming to collect their or cash out their check. So that is why you list these 4 unpresented checks right here because they are not shown here. So they are unpresented. You add them up, less them from the amount up here, and you get your adjusted bank balance, which is 19,499 minus 4,820, which is equal to 14,679. Is that clear? Yes, no, yeah, yes, okay. which aspect is not clear, Olivia? Two four one three. That figure, that is the figure for check number 3122, which you can find in your payment section. It's right here. So if you look under your cash payments, why you less it from your bank statement balance? So I was basically saying that, yeah. So why you less it from your bank statement balance is because, remember the example that I used? These are checks that I paid out to 10 of you guys. And you should remember, when you get a check and you go to the bank to cash the check, the money comes out of the person's account whose name is on the check. So if you have not yet gone to the bank to cash that check, then that person's account is not going to show that they paid you, right? But this bank statement now was closed off without without those four persons coming to cash their check. So that is why they term it as unpresented checks. They were not presented to the bank, right? So because of that, remember, if you had come and collected, then you would have been lessening my bank statement amount. So because you should have come and you probably soon come cash it, then I take them out from now because I want my bank statement balance to be reflective of my cash book balance. So that is why you less unpresented checks from your bank statement. So then that gives you the adjusted bank balance. So moving on to the balance as per cash book. So the balance as per cash book, and you look in your cash book right here, you would see 13,659. That is your balance, right? So you write that down. Remember, we went through the additional information and we put the plus and the minus beside what we're going to do, right? So this part should be easy to get through. Remember the EFT rent, we said that we were going to add that to our cash book amount. So that is the $300 that we're adding here. Also, the bank collection that we said we're going to add to our cash book amount, that is also the $1,300 that we're adding here. And the book error that we're going to correct, that is where the 520 here comes from. Add up all of those, you get 2,140. You add that to your cash book, balance as per cash book, and you get 15,799. Now, remember again the additional information that we went through. The dishonored check for 900,000, that was note 2. We decided that we're going to less that one from the cash book balance. The note 1, which was the EFT payment, we decided that we're going to less that one as well. And one thing that is always taken away from your cash book balance is service charge. The key tells us that SC means service charge. So here we can see that our service charge is $20. So you always less service charges because service charges come out of your bank statement, and we won't normally know like what is the amount of the service charge to take out of our cash book. So that is why it would not have been reflected on the cash statement. So that is why take it away, subtract it from the cash book statement so that both the bank statement and the cash statement can have the same amount for the service charge. So you less that 20 as well. So all of those would be 1,120, and then the ending figure, which should always be equal to the adjusted bank balance, would be 14,679. Those two figures should always be equal. So if they're not equal, then you'd have to go over something. try and remember the formula for the layout rather of the bank recon statement, and then try and sort out any additional data you get and see what you're supposed to do with each. So that is the bank recon statement. So you guys all right with that? All right, so we don't have a lot of time left. Are you guys fine with plant assets? Anyone else is going to answer? Um, Tanevia, are you still here?
I'm here.
All right, you can just they want a little go through of the plant asset, just a little go through.
Can you pull up worksheet 4,
The question or the solution?
the solution? The guys for plant assets will be working on worksheet 4, and we'll be doing tutorial question 1. So you can pull it up if you have it. Are we ready, guys? It's tutorial question 1. Okay, So before you go into any depreciation question or like to calculate the depreciation schedule, there are three things you should consider first: the capitalized cost, the economic life, and the residual value. So it's important to note that the capitalized cost is not only the cost that you pay for the asset, but it also includes financing of the asset. So installation or any transportation cost that should be added to the capitalized cost. And you know, the economic life is the useful life, and the residual value is basically the amount you can sell it for after its useful life. So going into the question, we're going to pick out the capitalized cost before we do anything else. And in this one, it says the system costs $325,000. So that is the cost. But it also says shipping, installation, and setup were an additional $35,000. So in order to get the capitalized cost, you would add that $325 with the $35,000, which should give you $360,000 if I'm correct. And so that's the capital. That would be the capitalized cost. And the next thing we're going to pull out is the useful life, which in this question is 5 years. Yeah, the system has an expected life of 5 years. And the residual value is 26,000. And you can find that where it says at the end of the useful life, Julie Hayes, chief accountant for Gencota, expects to dispose of the building system for $26,000. So those are the three figures you want to pull first and write them down, because basically you probably have to use them in all of the depreciation methods. So everybody know the straight line method. Okay, so what I prefer to do, instead of just going right into the schedule, I prefer to calculate the figures for everything first. So I would start with the straight line method first and calculate it. You know, once you get one figure for the straight line method, you get all of the figure there. So the formula for calculating the straight line method is capitalized cost minus residual value over the economic useful life. So the capitalized cost was again $325,000 plus the additional $35,000 for shipping, installation, and setup, which would give you, yeah, that. So, which would give you $360,000 minus the residual value, which we stated was $26,000 over the economic useful life of 5 years. So that is 334,000 divided by 5 years, which would equal to the 66,800 a year. And you can fill in the schedule with all of that because it's the same thing every year. Everybody get that, right? All right, so the next one we're moving on to is the unit of production. So before you're going to calculating the annual depreciation for the unit of production, if you don't get the depreciation expense per unit, you're going to need to calculate that. So to get the depreciation expense per unit, the formula is capitalized cost less residual value over the expected production over the life of the asset. So the expected production over the life of assets, it was given in the question where it says, he further anticipates total output of 668,000 bottles. Sorry, wrong thing. Oh yeah, right. She further anticipates total output of 668,000 bottles over the useful life. Am I right? Oh yeah. So the expected production over the life of the asset is basically how much the asset expects to contribute to production while it is still useful. So in this question, it's given as that. So to calculate the depreciation expense per unit, as I said, it would be capitalized cost, which is 360,000 as we calculated before, minus the residual value of $26,000 over divided by the 668,000, which would be 50 cents per bottle. Everybody see how me get that? Now you want to calculate the annual depreciation. Oh, you want me to repeat? So units of production, right? Before you get into calculating, no, that would not. Hold on, I'm going to repeat. So before you get into calculating the annual depreciation, first thing you have to do is calculate the depreciation expense per unit, because it's units of production. So you need to calculate the depreciation expense per unit. So the formula is capitalized cost less the residual value over the expected production over the life of the asset. So that would be 360,000, which we calculated in for the straight line as well. The $26,000 less the $26,000, which is the residual value, over the $668,000, and that would equal to 50 cents per bottle. So that would be the depreciation expense per unit. So to get the annual depreciation for the year, what you would do is multiply the number of bottles produced for the year times the depreciation expense per unit, which is the 50 cents per bottle. All right, great. So yeah, as I was saying, moving on to the second part of the question, which is the annual depreciation. So number of bottles produced for year 20x2, that would be $108,000. So to get the annual depreciation for that year, it would be the $108,000 multiplied by the 50 cents per bottle. Sorry, the 108,000 units or the 108,000 bottles multiplied by the 50 cents per bottle, which should give you an annual depreciation of $54,000. We get that? Or you want me to repeat? Okay, and you would just do essentially the same thing for the rest of the year. So 130,000 bottles for the second year multiplied by, somebody wants me to repeat? Sure. So we calculated the depreciation expense per unit at the first part of the question. So now we're going to use that to actually calculate the annual depreciation for the year. So to get annual depreciation for the year, using the units of production method, what we would do is we would calculate the production for the year multiplied by the depreciation expense per unit. And for this, for year 20x2, it would be 108,000 bottles, which it says in the question, multiplied by the 50 cents per bottle, which we had calculated in the first part, and that should give you a total of $54,000 for the depreciation for the year. That's it. And you would just use the 50 cents per bottle multiplied by the total output of bottles, so the 160 and the 120 for the rest of the years. So you would multiply those to get the annual depreciation for the year. So the third method of depreciation is the sum of the year's digits. So the formula for calculating the sum of the year's digits is beginning useful life at the end of year 1, remaining useful life at the end of year 1 over sum of year's digits times capitalized cost less residual value. So the first thing we're going to do is calculate the sum of the year's digits. So for the sum of the year's digits, what you would do essentially is, it's in this question, the expected life is 5 years. So you would add 1 plus 2 plus 3 plus 4 plus 5, which equals 15 years, which equals 15. So that would be the sum of the years. So remaining useful life at the end of the year over sum of the year's digits times capitalized cost less the residual value. So we had calculated those from start. So for year 1, using that method, at the end of the year, or when you bought the asset, you still have 5 years essentially of use out of it. So it's 5 over the 15, which is the sum of the years, multiplied by the 360 less 26,000. So that should give you a total of 111,033 rounded off, I think. Everybody get that, or you want me to repeat? Okay, so sum of year's digits. What you do first is you calculate the sum of the year's digits, essentially. So that is, you use the expected life of the asset. So if the asset, well, in this question, the asset has 5 years. So we're going to add each year individually. So we're going to add 1 plus 2 plus 3 plus 4 plus 5, which is 15. But if the asset had, for instance, 3 years, we would add 1 plus 2 plus 3, which would be, so the sum of the years would have been 6 in that case. So then we're going to move right into the formula after calculating that. So remaining useful life at the end of the year over sum of digits multiplied by the capitalized cost less the residual value, which we had calculated before, and it's $334,000. So year 1, we would say, you would just say, okay, we still have a full 5 years remaining out of this asset. So it would be 5 over 15, 5 over the sum of the digits, which is 15, multiplied by the capitalized value cost less the residual value, which is 334,000, and that should give you a sum 333 for the annual depreciation for year 20x2. You get that now? Alright. So you would just continue for year 2. So for year 2, you would say, okay, you have 4 years left. So that would be 4 over the 15 times the 334,000, which would give you $87,067, or $89,067 rather. And you just continue that for the rest of the year. So moving on to the double depreciating method. So there are 3 things you're going to do 3 things in order to calculate the double depreciating method. You're going to first calculate the straight line rate. So the straight line rate is 1 over the useful life of the asset. So first thing, you calculate the straight line rate. 1 over the useful life. 1 over 5, 20%. Got that. You're gonna need it. Then you're going to do the double declining rate, which is double the straight line rate. So 2 times 20%, 40%. Then you're going to calculate the double declining expense for the year, which is the double decline rate times the net book value of the beginning at the beginning of the year. So the net book value at year 20x2 would be 360 because no asset just by no depreciation I did it. So that would be 40% of 360. 40% of $360,000, that's the net book value. The depreciation, you're good. So that would be $144,000 would be the annual of that year. So you're going to subtract the accumulated depreciation from the net book value of from the previous year. So you're going to calculate the 144,000 from the $360,000, which would leave you a total of $216,000. And then you would multiply the 40% by the $216,000 to get the accumulated depreciation or the annual depreciation, which would be $86,000. We understand that our many figure over it. All right, give me a second. So it's essentially the same for the other years. So you would let Chanel, you can go over please so them can see the other end of the table. All right. So for the other years, you would add the 86,400 for that year to the $144,000. And you could you scroll down for the sake of it? All right. So you would add the 86,400 to the 144,000, which would give you 240,000. So you less that from your initial 360, which would give you 129,000. Or you could just simply, if you did it like me and you had the accumulated depreciation and net book value in one table, you could just simply less the 86,400 from the previous 260 net book value, which would give you the same 229,600. It kind of makes it easier if you add tables for net book value at the end of 20x3 was 129,000. So what we would do is find 40% of that 129,000, which would be 51,840, and that would be the annual depreciation for that year. And you just continue doing that until the years are finished. Everybody understand that? Everybody good? Okay, Chanel, scroll down.
Scroll down more.
No, that's okay.
Okay.
So part 2 of the question asks you to prepare a revised depreciation calculation using if the useful life estimate was revised at the beginning of 2024 to anticipate a remaining useful life of 4 additional years, in other words, a total life of 6 years. The revised useful life was accompanied by a change in estimate salvage value to $34,400. So the first thing we're going to calculate is the new depreciable cost. Okay, how do we do this? Give me a second, guys. Okay, sorry about that. So what we're going to do is the net book value minus the straight line method depreciation, which was the 66,000, and you multiply by that by the amount of years added on, or the amount of years left after 20x4, which would be 2 to 20x6. And then you're going to multiply, you're going to subtract the new salvage value from that. So the depreciable cost would be 192,000 instead of the 26,000 that was there. And then we're going to, well, the new remaining useful life was already given in the question. All right, so we're going to use the, because it says take it from, we're revising it at the end of year 20x4, right? So we're going to say the net book value, or the initial net book value, which was 360,000, minus the depreciation rate, which is 66,800, multiplied by 2 for the years that would be left, which is 20x5 and 20x6. And then you must subtract again the salvage value to get to the new depreciable cost, which is 192,000. The new remaining useful life of 4 years was already given, so not necessarily any need to calculate it in this question because it was there. So the new annual depreciation would be the 192,000 over the remaining useful life of 4 years, which would give you $48,000 per annum or per year. So the correct formula would be NBV at revision date minus revised residual value over the remaining useful life of the asset. So what we had calculated first was the NBV at revision date minus residual value. So there is no revision date. So the NBV at revision date would have been the 360 minus the 66,800 times 2 to accommodate the other 2 years that were left after. Also, it's multiplied by 2 because though we're calculating at 20x4, there's still another 2 years left after 20x4 to calculate the depreciation from. So you have to revise it for that. Somebody had asked how we got the 34,400. It's the estimated, it's our revised estimated salvage value, and it was given in the question. So 360 minus the 66,800 times the 2, and then you minus the salvage value or the revised residual value from it. Also, if it had 20 times 7, you would multiply it by 3. Yeah, basically, yeah. And that would be over the remaining useful life, which would be 4 years. So the revised depreciation per year would be $48,000 for the additional 4 years. Everybody get that? Okay. Great. So I think that's it for depreciation. You know,
Yeah.
anything else re depreciation to go through? Any other questions or concerns? All right, disposal. Let me find a disposal question. Is number 2 a double decline question? Sorry, is number 2 a disposal question? Okay.
Yeah.
All right, give me a minute. On January 5th, 2015, a company purchased a new machine for $130,000. Where's the journal list? All right, question number 2. It says the company, on January 1st, 20x5, a company purchased a new machine for $130,000. They expected to use the machine for one, you want to prepare the necessary journal entry to record the purchase of the machine. So So an increase in the equipment figure, increase in machine or equipment, that would be a debit of 130,000 in the general ledger. And they weren't specific as to what method we used to pay for the thing. So we're going to assume it's either cash or accounts payable. So a decrease in cash would be a liability, or an increase in accounts payable would be a liability. So it's credited. So part 2 says, what is the book value of the machine on December 31st, 20x6 if the company uses the straight line method of